Here's another look at markets in the early minutes of trading. We're now 7 minutes into the trading day today. You can see the S&P TSX Composite has a good advance going of about a quarter of a point. It's now above 22,400 points. That puts us within striking distance, perhaps, of an all-time high. We would have to get to 22,555 to reach the highest level ever on the TSX, or 22,463 to match the record high closing value on the S&P TSX Composite Index. The S&P 500 in the United States is almost exactly flat. That number that you see on your screen was a record high closing value of yesterday, and the NASDAQ Composite is also very, very flat this morning. Well, let's bring in Philip Petursson. We'll have another look at the markets as investors continue to digest the latest inflation prints south of the border. Philip Petursson joins us now. He's Chief Investment Strategist at IG Wealth Management. Philip, great to see you again.
Good to be here.
Let's talk about the big story of the day, and that's the U.S. inflation numbers. What's your take?
Well, what a number, right? Minus 0.1% inflation on a year-over-year basis at 3%. I mean, it sets up the stage for the Fed to easily cut rates in September. And this morning you saw the probabilities of that jump in the futures market to, before I left, 88%. So up significantly from where we were just a day ago. This is a positive surprise on the inflation front. You can see the markets are trying to digest it, saying, is this good news now bad because it signals weakening in the broader U.S. economy?
Right. I was going to ask that. There again is the middle line and the bottom line are the U.S. equity markets. They're barely moving at all. And I think viewers will remember that many times when inflation comes in softer than expected and chances of a rate hike are perceived as being greater, we see the markets jump, and sometimes jump very substantially. But you're giving us some good insight here. But the debate is now shifting to should markets be concerned about a softening U.S. economy?
Exactly. I mean, look at what's happened over the past 2 weeks in terms of economic data that's come through. We have unemployment in the United States at 4.1%. That's above the Fed's target of 4% for the end of the year. So that in itself is a little bit concerning. You have the ISM Services Index, with services being the backbone of the U.S. economy. That dipped below 50, so that's in contraction phase right now. That's not positive for the U.S. economy. So there are signs that there are cracks. And so this weaker inflation data, on the one hand, again, it's good. Inflation is normalizing back to the, we'll call it 2.5% to 3% level, but it might be a sign that the consumer is starting to gas out.
What's your call now on the Canadian dollar? An earlier Fed rate cut is Canadian dollar positive, U.S. dollar negative. Has your view on the loonie shifted at all? It
hasn't. So we've been consistent with the view of a weaker Canadian dollar vis-a-vis the U.S. through the remainder of this year, while the U.S. Fed funds futures jumped, expecting a cut almost solidly, I would say, for September. When you look at Canada for July, they jumped as well. So I would argue that the Bank of Canada is going to cut in July and is going to cut at least one more time after that, perhaps twice. So we still see the Bank of Canada cutting more than the Fed, and that should put downward pressure on our dollar going forward. U.S.
earnings season is now underway. Delta and Pepsi have reported results. Neither one of them have exceeded expectations. Three big banks come tomorrow, and then we will get a flood of very nearly all 500 companies on the S&P 500. What's your expectation for second quarter earnings season?
Well, I think second quarter earnings will come in above expectations. So I think we will see positive surprises, but more importantly, it's the forward guidance, and that's what we got today. Look, Pepsi they beat on terms of earnings, but their volumes were down. And the guidance, was a little softer, I think, than what we would like. Delta, the same thing. And look at what's happening with Delta. So there are signs, again, this is all coming to the forefront, that the consumer has exhausted their excess savings post-COVID. And now with unemployment starting to tick higher, it's weighing on consumption broadly. And it's being reflected in, at least for now, these consumer companies.
What's your call on U.S. equity markets for the second half of this year?
Well, we still have a positive view, but we're a little bit more tempered in our expectations. I think the markets could be up anywhere between 0 and 5% through the remainder of the year. If you assume that earnings growth comes in as expected for the year, which we do, and then valuation stays in line with where it is. So we're still constructive on the U.S. equity markets through the remainder of this year, and we think it'll lead other markets as it has.
And Canadian markets?
Canadian markets, we think, will lag a little bit behind, being hampered by some of the stresses on the Canadian banks. Our economy is weaker than that in the United States. The banks are increasing loan loss provisioning. That's as a direct impact on higher interest rates on the consumer and delinquencies and that are following as a result of that. And then energy, which is the other big component to the TSX, we see it at $80, $85 a barrel. It's hard to see it move up, but valuations within the energy sector are fairly rich.
Do I hear you saying you don't think the Canadian bank stocks will have a great second half of this year?
Exactly. Yeah, we've seen they've moved up in terms of valuation, while profitability has actually come down a little bit. So, that's the opposite of what you want. I want increased profitability with attractive valuation, and that's not what we have today.
What's your view of the big tech stocks in the United States? Will we see a broadening out in U.S. equity market leadership as investors move perhaps out of some of those ultra rich names into other sectors of the U.S. equity market?
Yeah, I think we can. I think we can get a repeat of what we saw in the first quarter. Right, in the first quarter, there was good, healthy breadth to the U.S. equity market. That kind of gave way to a narrowness again in the second quarter and start of the third quarter. Hopefully, we see a broadening out as the fourth quarter emerges.
Phil.